G'day folks, welcome back to another update for gold and silver. And before we go any further, make sure you hit that like and subscribe button to support the channel. So silver and gold are both still in a bit of a downtrend, a bit of a bearish outlook, although there is a minor bounce still in play at the moment. We'll have a look at the charts in a minute. First looking at the outlook. So for gold, as of today, December 23rd, almost Christmas Eve, gold prices have risen by 0.2% to 26.26 per ounce, recovering from a recent dip following the Federal Reserve's cautious stance on future rate cuts. Silver has increased by 0.7% to 29.72 per ounce, showing resilience alongside gold. The Fed Reserve policy, the Fed's recent 25.25% rate cut and indications of a slower pace of future cuts have influenced precious metal markets, with higher interest rates typically reducing the appeal of non-yielding assets like gold and silver. The indicators for economic indicators, a slowdown in US inflation and strong economic growth have impacted market expectations, affecting demand for precious metals as safe haven assets. Investor positioning, speculators have recently reduced their long positions in gold, indicating a cautious market sentiment. For the industrial demand, silver's extensive industrial applications continue to support its demand, contributing to its price movements. And geopolitical tensions, ongoing geopolitical issues such as conflicts in Gaza are influencing investor behaviour, often increasing the appeal of precious metals as safe haven investments. So first looking at gold long-term trends, we always look at the monthly, weekly and daily trends. So on the monthly here, we've got the CCI 150 is still above its moving average, although it's pulling back towards that moving average range, which will indicate a weakening in price, especially if it breaks below. That'll be bearish. At the moment, it's still bullish. You can see there the price above its respective moving averages. That's still a pretty strong price movement, but again, be cautious. We might see a bit of a weakening outcome in the coming days, possibly, or early into next month. To learn how to draw these indicators, by the way, these moving averages, the video's in the description below, so just follow that to learn how to draw them on your charting software. On the weekly, that's already broken down into a bearish outlook. You can see that the price is also pulled back towards its moving average. Now, you'll notice here we had a bearish divergence versus higher highs in the price, and I've actually drawn a Fibonacci indicating the minimum retrace level, and that minimum retrace happens more than 90% of the time, that 23-38% Fibonacci retrace. You can see there it bounced out just below that 23%, and it's now been hovering just above it in the last few months. So again, the CCI is still bearish below its moving averages, so we might see further price weakening in the coming weeks. So again, that was the weekly chart. On the daily, it did actually hit this resistance at 27.90, and it's been fluctuating in this minor support and resistance range between 25.66 and 27.26. But again, you'll notice the CCI is moving in line with the price now, but still weakening. It's still hovering above and below that moving average line. But at the moment, both the price and the CCI are bearish at the moment, with a very slight move to the upside. There was a bearish divergence here, lower highs on the CCI versus higher highs on the price there. And you can see there it broke down and hit another 23-38% minimum. Again, that's a minimum retrace. And by the way, these divergence are independent from each timeline, so they're not necessarily always aligned between the different timelines. Now, if we go to the intraday charts, we only trade, if you're trading on the intraday, I've got here the 1 hour. You can interchange this with your 2 hours or 4 hours or even 15 minute. So we always go in the direction of the daily trend. So you can see here back from that point on, you would have taken short positions, and you can see there the short positions would have been quite nicely executed had you followed the daily trend. They don't always work, of course, but again, we go with probabilities, and in terms of probability, we do trade in the direction of the higher time frame. Now you'll notice here, even though the daily is still bearish below its moving average on both the price and the CCI, the price and the CCI moving averages have been broken to the upside. We don't go long, we only go short. So again, if and when this breaks below the moving averages of both the CCI and the price, as long as that daily is still bearish, we'll take a short position. So for silver, similar sort of story. You can see there on the monthly, the CCI is just about breaking into that moving average range, so it's weakening. The price is still bullish, although again, that's also weakening slightly. It could always bounce off that, of course, but we always take it one step at a time. We don't get too advanced in our projections. So again, that's a weakening sign. On the weekly, that weakening sign has been shown quite easily. You can see there's also another bearish divergence versus higher highs on the price, and that actually broke below that 38% level with that wick of that candle. Let me just blow that up. And you can see there it's actually hovering around that 38% level at the moment. Although notice on the weekly the CCI is still bearish, so no major sign of a pullback yet to the upside. On the daily, again we've got another minor support and resistance range here at 28.74 to resistance at 32.96, and it's bounced off that minor support level. But again, you'll notice on the daily it's broken down below the moving average range, so only short positions to be taken on the intraday. Now if we go to the intraday chart, the 1 hour chart, again short positions only. You can see there you would have taken the first short positions from that point when it broke below, getting out of the trade when the CCI breaks into that moving average range, and you'll notice that when it does that, it's near the bottom of that range, so it would have been a more profitable area to get out of. Now in this example you could have actually stayed in until it hit that moving average range of the price, but what happens more often than not, if it does break into that moving average of the price, you lose a lot more profitability, so you get out of it a lot later, in other words, than getting it out of it when it's hit the CCI. Now in this example, when it hits the CCI, you get out of the trade and you get back into trade in one of those candles when it breaks below there. You can see there on the price and the CCI, and again getting out of the trade near the bottom there. That went sideways for a while. Don't go long. At the moment it's showing long positioning. So again, similar to gold, you wait for that to break to the downside along with the price. So long as that daily is still bearish, you take short positions only. You would only start taking long positions when the daily breaks higher on the price and the moving averages of the CCI. To support the channel more, hit that like and subscribe button and share the video. For added benefits and the cost of a coffee, consider subscribing to the Patreon page, where we look at weekly scans of bullish trending shares and insider trades that may have occurred. Thanks again, and see you in the next video.